quite interested in whether things fail or succeed generally. I guess you all are. And one of the things that I'm interested in, as a person who used to work in the derivative markets myself, and we used to muse over this question quite a lot while we were there, is what makes a derivative contract succeed and what makes it fail. Now, you all know what a derivative contract is all about. Fundamentally, from an agricultural point of view, it's about managing risk, right? From the point of view of investors, it's about trading, making money, and all the rest of it. But, of course, we're managing our risk. Now, there has been quite a bit of Western academic research into the question of am I allowed to give these slides out? I mean, is there any reason why anyone needs to take photographs? I mean, just take a copy of the soft copy. You take it away. I mean, it's fine by me. You don't need to take photographs. There's been quite a lot of academic research about what makes derivative contracts succeed and what makes them fail. Now, the interesting thing about this, to me anyway, is that predominantly this research lies around, well, pretty much precisely the time I was trying to launch futures contracts. You can see it's sort of temporarily concentrated, if you like, around the 1980s with a bit of dispersion, in fact, either side. And that's when people had a real interest in launching agricultural futures contracts, and they wanted to know what might make them succeed. And one of the reasons they were interested in this is that most of them don't succeed. But, of course, in order to understand whether most of them succeed or not, you have to understand what a criteria of success might be. That'd be handy, wouldn't it? And unfortunately, not everyone actually agrees what that might be. Of course, everything fails in the end. Don't they say that all political careers end in failure, and all derivative contracts end in failure eventually, of course, although some of them have been going on quite a long time, a couple of hundred years or something like that, so the jury is still out on them. But the sort of things that people were quoting were annual trading volumes in excess of 1,000 contracts, or 10,000 contracts, or 1,000 contracts daily, or 10,000 contracts daily. So any of those will count. But 5 contracts daily, 50 contracts daily, 50 contracts a year, that sort of thing definitely doesn't count as a success, at least so far as the academic literature is concerned. So, of course, if you look at the fact that the criteria for success are rather different, then it's not going to be terribly surprising to find out that people's understanding of what makes them succeed will be different, of course, starting from different bases, naturally enough. But even if you look at it from the point of view of rough understanding of an average on these sorts of things, say 1,000 a year as a rough guide on these sorts of things. If you ask me what a criterion for success ought to be, as an economist, I would say net present value for the exchange, because they're profit-making institutions. So if they know what their cost of capital is, they know how long it's going to take them to market the contract, they know how much revenue they're going to receive, then it's a fairly straightforward investment decision like any other investment decision. But at the time most of these analyses were done, that was not people's perception. And to be fair to the academics doing the work, most of the exchanges that they were looking at were not profit-making institutions at the time. So they had to look at some sort of quantitative measure instead. So these are the sorts of criteria they came up with. If there was a free market, would help. If the volatility was below a certain amount, and of course there was some disagreement about what that might be. If the cash market was of a certain size, that would help. If there was little competition, obviously in terms of other contracts, would be considering. If there was understanding, sufficient knowledge of understanding of derivative trading by potential market participants. If there was manageable basis risk, I take it you all know basis risk, the relationship between one variety and another variety of a particular agricultural commodity. They don't go in different directions, as famously happened between Liverpool cotton and New York cotton, busting the Liverpool cotton market when it happened. So there has to be manageable basis risk. They can't all go off in different directions. And then the contract design, which I can say personally from experience has some considerable impact on all of these things. Things like what variety you pick the wrong one, and people won't be interested in it, what your delivery points are, how big you make the trading lot, too big, and nobody will be prepared to take the risk on, too small, and they'll accuse the exchange of making money out of the trading market participants. So you've got to pick a medium point that everyone's happy with. How much the tick size is, that is how small the amount is to make the market move by 1 unit or 2 units. Again, too small, and people will be looking at it all the time and won't be able to follow. Too large, and people will feel that you're not capturing all the degree of volatility in the marketplace. And the delivery points. If it's going to be a deliverable contract rather than a cash-settled contract, then people are going to have some considerable interest in what places it's actually delivered. If you get that wrong, again, if you get the place where it's not mainly delivered, then it's not going to be helpful for the survival of the contract. And certainly you can point to many agricultural contracts that have failed for one or other of those reasons in Western markets of one variety or another. Seems reasonable to me. And finally, some aspects that have been loosely described as exchange policy and marketing that we might want to consider later. So, what about red chilli? I take it we all like chilli. I love chilli. Marvellous stuff. Spices for foods and sauces and ketchups and all the rest of it. Large amounts of vitamin C, you'd be amazed to know, and carotene. And of course used to prepare red chilli powder, naturally enough, obtained from the crushing process for dried chilies, which has some pretty important uses, some medicine, but mainly used for cooking and flavouring and all the rest of it. The world generally loves chilli and is loving it more and more. So if you look at production in Pakistan, in fact, the general trend to the level of production is down slightly in Pakistan. Certainly in the last decade generally. But yield is up slightly, so production the area has sown as down slightly, but the area production is slightly up. The leading area, I didn't put a map on because it would be a bit confusing to try and spot pick individual towns and so forth. But as you see from the slide, the vast majority of it is grown in one province. Now that's one province of Pakistan, so that's quite a large area. We're talking hundreds of kilometres. And if anyone's been to Pakistan knows it, hundreds of kilometres means hundreds of hours of transport and getting from place to place. Not the easiest place in the world to get around. But the production is concentrated on one town, Chilli, capital of Pakistan, Kunri, which is quite an interesting fact as a place to go and put these places. More importantly and more interestingly, from our point of view, they are concentrated on producing one variety, variously described as Dandicot or Dundicot, and they produce some hybrid. But it's mainly used for red chilli powder. And it's produced vastly more than the hybrid variety. And equally importantly for us, it is the benchmark which is used for Pakistani chilli pricing throughout the country. So having one variety which is used for that purpose is, of course, exceptionally, potentially helpful for us when we start to think about derivative contracts. Transport's certainly not quick. I mean, I'm not joking about the distances. It's almost 500 kilometres to get from Kunri to Karachi. And by the time you get to Karachi, I mean, Karachi itself takes hours to get through, as those of you who've been there will know. So we're talking a long time to get the whole exercise there. On the other hand, warehousing and handling, as is the typical problem with Pakistan, remains permanently a problem in the area. They don't have proper warehouses, and they lose a substantial quantity of that harvest as a result of it. Partly because of the poor warehousing and handling, they have a very small share of the export market in Chile, and as a result of that, and it's just that compounded disaster story that we're familiar with, you end up with discounts to Indian chili. Now there's that word, Indian, which of course you mustn't mention too much when you go to Pakistan, but there you go, is of course trading at a discount to Pakistani chili in the open market. So some possibilities that would lean to us as a result of all of this, but not perhaps an ideal situation, at least looking at it from that point of view to start with. So PMEX, the Pakistan Mercantile Exchange, started to look at the prospect of launching a derivative contract in red chili. And when they did this, they decided that they had certain logics that they looked at, certain reasoning that they thought was supportive of the idea of launching the contract. So they said, well, no price premium is available for quality produce. So if the farmers are producing decent red chili, and others are not, then the farmers that are producing the good quality chili are not getting a benefit from it from the market system they're operating in, the so-called Mandi system, the central market system that operates in Kunri. So that's a problem. So as a result of that, of course, people being what they are, there's a disincentive to improve the quality of your crop, which nobody really wants, and certainly the government doesn't want. There's a delay in payments from the traditional Mandi system as well. And we're talking considerable delays, weeks before farmers are getting paid. So that's problematic because obviously farmers there are living pretty much hand to mouth, and certainly from one season to the next. So extensive delays like this are going to pose significant cash flows problem for one reason or another. Next difficulty, there are some what do they call undue deductions at the Cynre Mandi. The prices that are supposedly in existence for the open market for red chilli are not actually being received by the farmers who are putting their produce up for sale at the market. And that's because the brokers, generally speaking, are running a coordinated buying exercise at the Cynre Mandi, and they are responsible for setting the prices, which one could more or less describe as a sort of coordinated, organised monopsony, essentially, which is producing some difficulties for the farmers as well. Commissions, 4 or 5% worth of commission as well, and then pilfering during the repackaging as well. Overall deductions pushing that above 10%, so quite a considerable difficulty as well. Farmers aren't even sure about how they should improve the quality of their crops, so they're not getting that information out, and the brokers aren't really telling them either. There's not much in the way of quality seeds available, particularly for the Dundee Cup variety either, not terribly helpful. PMEX says that in their view there is a sufficient cash market. How big the cash market is in relation to the process of value creation, however, might be something to consider, and we'll have a look at the value chain in the red chilli in the next slide, but that's something to consider. No viable alternative market for managing risk, absolutely. PMEX structurally and in terms of correlations of price, reasonably confident that you're not going to be able to use the Indian derivative markets to hedge Pakistani chili. Now, in practice, it's just absurd to imagine a farmer in Pakistan using an Indian market to hedge chili. They wouldn't know how to reach that market in the first place. No Pakistani broker would give them an opportunity to trade on it. The prices would all be in a different currency. You just stack up the reason after reason after reason as to why Pakistani farmers wouldn't use an Indian contract. The one encouraging thing about the Indian contract is it exists at all. There are two major commodity exchanges in India, MCX and NCDX, and both of them have tried to launch a red chilli contract. The NCDX contract is actually live, and was live, has been live for some time when PMEX was actually investigating the question of the red chilli contract. So they had a benchmark and something to investigate, and we'll have a look at some of the comparisons between the contracts in just a minute. So that's handy. The MCX one didn't succeed, but the MCX one was just a deliberate attempt to go against the NCDEX one for its own sake. So the fact of the MCX one failing didn't necessarily discourage PMEX in considering what opportunities they had. So that's that. Right, so there's the value chain, at least allegedly, according to these people, the Pakistan Agriculture Coalition, who are an organised group of people come together to support PMEX in their development of agricultural derivative contracts in Pakistan. And they've got quite a few challenges, not least price fixing generally. So that's the structure, and they're quite interesting, I think. The wholesale profit is, of course, exactly what you're targeting when you're trying to hit with a derivative contract of one variety or another. So definitely opportunities to break that, to disaggregate that, and to put more money in the hands of the growers, potentially. Price volatility, well, you make your own decision. There is no absolute answer. No one in the academic literature says, right, you can just put the graph out and say, if it's below this, it won't succeed. But certainly looking at this for me, I mean, this is a relatively short time scale. This was given to me by PMEX. That looks like almost 50% spread within a one-year period. And if I compare that to the cotton contracts and the other commodity contracts that I've looked at over the years, this certainly passes the test in the short to medium term of sufficient volatility. I think if we were probably looking at just that half of the curve, then I suspect that most derivative traders would say, well, 5, 6, 7, 8% swing in the course of 3-4 months doesn't look terribly impressive. But if you look at the previous period, I think we can be reasonably inspired by that in terms of volatility. That looks sufficient to me.
So what's the seasonality?
Oh, the seasonality, there's a production phase in the autumn and then a harvesting phase in the spring. So you've got the usual exercise of running like that. So the prices drop during that autumn period and then come back up. And that's fairly typical. So that's not entirely encouraging from that point of view, but the extent of that every year differs depending on the nature of the harvest. So the degree of dip changes substantially, but it's an excellent question.
Julian,
yes?
I'm conscious that some people in the room are not so familiar with derivatives and futures contracts. Maybe you could explain why that matters. Why would it
Okay, yes, sure, yes. If you know exactly where the price is going to be at any point in the cycle, then the futures contract will reflect that already. So there won't be any opportunity to trade out of that. You'll effectively already have that booked into the future. It's the simplest way I can describe it. Thanks, David. Yes, it'll effectively booked in. So that's why that question's so important, because if it's the same every single year, then you're looking at what looks like volatility, but it isn't really volatility because everyone knows what it's going to be. Yes, volatility only matters when you don't know what it's going to be. So the variation regularly, it's a very good point about the seasonality, though. But it's certainly, from PMEX's point of view, they're happy enough with that degree of volatility over time. And certainly, I have some other anecdotal stuff from India and elsewhere to demonstrate that there can be occasions when the red chili price can move even more dramatically than this. It can go up 50% in the course of 2 weeks or something of that nature. But I don't have any firm evidence that the Pakistani chili market has done that, certainly in the past 2 years or so. But I do have some evidence from 2010, 2011, something like that, that the Indian chili market can go and do that, and that's very much without anyone predicting that it's going to happen like that. So that's why it matters. Yes, thank you, sorry. That's one of the dangers of being constantly stuck down a narrow tube, isn't it? You can't see what other people can see about the whole thing. That's a very valuable point. Okay, so they went ahead and launched it. And I thought this was really quite interesting. I mean, I would, wouldn't I? But it's an interesting reflection on what contract specs look like. These are key points about this. So you see that in Pakistan, they went for a smaller contract straight away. That's a typical Pakistani gambit when confronted with anything Indian. We'll do the same, but we'll do it smaller and better, if we can. But most likely that's going to be useful. So that means that they can get the same turnover in contracts with a much smaller overall volume of traded chili. That's central to the analysis. Look at the price quotation again.
They like that because they're getting a commission.
Well, they have to balance that question. If they go too much down that line, then everyone's going to say, well, look, the Indian exchange only gets 1 rupee per 100 kilograms. You're getting 2.5 cents per kilogram. So that's not fair, because they will know.
That's the reason they would be pushing in that direction.
Oh, yes, from the exchange's point of view. But not just for that. Don't be too cynical to them about that. It's also about liquidity. Right. It's also about getting the volume of trade in the market to get it to go. In fact, as a former derivative person from that, it's not just about making money for us. It's also about making the exchange liquid, the contract liquid. Tick size a bit bigger, which is interesting, isn't it? And this comes to what they actually did in the end. And you'll see that there's no initial margin, so you don't have to put any deposit down. The reason for that was that when they did all the lobbying and all the analysis, and they did quite a lot of analysis before they launched this contract, what they decided in the end was not to launch a futures contract first, but to create a spot contract first. Now that makes great sense. If you've got a market which is opaque, and you want to think about creating derivatives, I know to my personal cost, and you can put it down as a law if you like, that if you don't have a spot benchmark, you're not going to succeed in creating a futures contract. It's never been done. We tried it in London in 1991, and I can tell you it doesn't work. It's never been successful. It's one of those guaranteed requirements. You've got to be able to benchmark the present to be able to determine what you want to pay in the future. If you don't know what the present is, how are you going to say how much you're going to pay in the future? Very difficult to do. So the first step for the exchange has been to use a futures-like contract, but with a ridiculously short delivery time, like 2 weeks. So that instead of trying to guarantee prices out for years, you're actually only trying to guarantee prices out for a very, very short space of time. And that's what people are trading now. So they're not so much managing risk at the moment as organising process. But it's a first step in that direction, and having listed that, they can then go on listing other things going out into the future. And of course, Equally important for them in this regard was to have compulsory delivery, because that's the whole point from far as PMEX is concerned, and the people who are supporting the PMEX contract is to be able to get hold of the red chili and to have all the quality qualifications and all the delivery qualifications and so forth that PMEX have created as a result of all this. And they have done more. I mean, they've also set up warehouses. They've done all sorts of things. Well, let me show you what they've done and what the advantages of what they're actually doing in this respect actually are.
Sorry, can you remind me which of the Indian markets was successful?
This one. That's just a copy, basically. I mean, I know the guy very, very well around MCX. Lovely, lovely man. I'm very fond of him. But once he got into other things, it wasn't likely that this was going to have the degree. And anyway, I'm not sure India can support 2 red chili contracts. The MCX one, if it was going to work, was going to knock out the NCDEX one, not actually compete with it like that. There wasn't going to be lots of basis trading between the two or otherwise.
The issue with delivery, is that about quality?
Yes, highly so about quality. Standardization, quality, but not just that. It's also about storage. So these are the advantages of the contract. I'm acutely aware of my timings here. These are the reasons why they believe that the contract is likely to work, and this now should come as not much of a surprise to you all. Low correlation with Indian red chili prices, definitely, but the other reasons as well, why they can't possibly use the Indian market. It's just a non-starter. So if they're going to use any market at all, it's going to have to be a local Pakistani one. The contract size, they reckon, is much more suitable to Pakistani conditions, 1/5 the size there. Physical chili trades are smaller in Pakistan anyway. The average size of a farm is smaller, contract farm. The average size of a farmer's land is smaller, everything from that point of view. So the exchange balance there is important for them, but they reckon they've got that one right. I've mentioned the point already that they have spot trading. All trades at the exchange so far converted into physical trades. This contract's been going on about a year or so, and they're going to introduce longer dated trading as they go. So the farmers are now receiving a rapid payment, so they're getting payment within 48 hours. Rather than the much longer period that was actually happening there as well. They've got 2 different qualities out there, 3 different qualities officially, A+, A and B. The only ones that have traded so far has been A+ and A, so that's quite usual. You go and launch a number of different specifications for a futures contract like this, and you find that one of them takes off, and that's where the liquidity ends up getting concentrated, and the others don't matter very much particularly. So transparent pricing mechanism, efficient price discovery, all the usual arguments, the electronic trading platform, quality grading of the produce at the farm gate, reaching more buyers through electronic trading across Pakistan. One of their buyers is a major Pakistani trading operation, which is quite helpful. Extension services to help the farmers grow better quality produce. Real-time information of product prices being available now through mobile devices, which is nice to see finally having happened. But also, another important part, and I think something that you as agriculture people will be particularly interested in, they've also meshed this with the development of a warehousing service for local farmers, which is a real innovation. They're trying to address precisely this problem. They don't have the necessary quality of warehouses. So they've actually got hold, the firm called Agility, which has been working with PMEX on this. They've got hold of a decent warehouse in the Kunri area, and they've modified it to be entirely suitable for and specialised in, pretty much the first warehouse in Pakistan that is specialised in, the storage of red chili. So they've got, it's 200 tonnes worth. It's not an enormous amount, but that's a fair bit, actually. So it's got ventilation fans, raised platforms with wooden pallets, lockable main door, and of course temperature more or less controlled, at least to some extent. So you've got a specialist warehouse to reduce your losses. And what we're talking about now, going forward, they can only keep it there for 24 hours or so under the contract at the moment. If there are longer dated contracts, there's going to be a need for storage, but they're hoping that this contract will actually start opening the opportunity for warehouse receipt financing in Pakistan, which has been a desire of the US government to help create through the US aid policy, I've discovered, for the past 41 years, trying to get this started in Pakistan without any great success. So it would be good, wouldn't it, if they actually managed to succeed that objective. And in general, this is pretty much according to PMEX, and I've been working quite closely with Mr. Mahmood, who's the product development manager at PMEX, who was in charge of this. He's a really nice chap who was on my course in Karachi. That they are pretty convinced that the conditions in India were fairly similar when NCDEX originally launched their contract. So they have some optimism in being able to say that they think they've got some success going for them. They're not completely guaranteed of success, though. Throughout Pakistan, and this was very much the elephant in the room when I was talking in Karachi, it was perfectly clear that there were substantial interests, not just in red chili, but also in much bigger areas, particularly wheat, to fix the price, essentially, of wheat for distribution inside Pakistan. This being done in collusion between various organizations, and the exchange was fighting against that in trying to create price transparency. Exchanges are always trying to fight against that sort of collusion of one variety or another because their prices, by definition, are visible by everybody. So that they regard as one of their main obstacles, but they are reasonably convinced that it's a bit like prizing open a clam. Once it starts to get prized open, then it becomes very, very difficult for the people responsible to push it back in again. And that's the hope here with red chili. Doing it effectively for the Pakistan wheat market, however, might be something that's beyond the capacity of PMEX alone to be able to achieve, although they are gradually acquiring more power and authority. Second objection or problem that they can see are perfectly valid, the usual problems associated with education and so forth in the rural environment. Starting with a spot market makes great sense because they don't have to try and explain to the local farmers exactly what they mean by a futures market, get the spot market and the contract specification working right, and then they can start introducing the concept of later dated contracts slowly, and they just drift effectively into a futures market without too much difficulty, hopefully adding the warehousing as they go. Liquidity is always slow to build in these contracts. I'll tell you what the results have been so far shortly. They've succeeded at least in getting it going, but it's not the same as launching a spectacular contract anywhere else in the West or something of that nature which really succeeds immediately. Liquidity is a painstaking process to build. I know it myself from having tried to do it. And that's obviously its key. It's a measure of success, but it's also, in terms of open interest, number of contracts that are outstanding in the marketplace, but also in terms of volumes, it's going to be a long job to go and do. Now, at the moment, there is an obstacle further in respect of the warehouses. They're just not economic to build. And the government isn't going to build them anytime soon because they've got all sorts of reasons for not wanting to build the warehouses. After all, the government of Pakistan can build a nuclear bomb. I'm sure they can build a warehouse if they wanted to, but they haven't. And they have good reasons for doing that. You might be able to work out yourself. So the building of warehouses is a costly and currently uneconomic exercise. So it's going to require, and they hope to get this, economic support from US government or World Bank or anybody else to get this to come together. And that's what I was there for, to try and help improve their competence levels so that they would be eligible potentially to get World Bank grants to start construction of warehouses. So good luck to them on that. And the final one, of course, is that if there are any stable prices, then that's going to reduce the chances for hedging. Now, they were very kind enough to provide me with some really interesting data, which was that the various partners involved with this, sharing the revenues that they were receiving from the trading, Agility, the coalition of lobbyists, essentially, and supporters who are doing the marketing, and PMEX. Now, they said that if they got a 4,000-ton volume, they would get a profit. Now, they mean by that, of course, a 4,000-ton volume in 1 year. Now, I don't know about you, but returning an investment in 1 year is a fairly unusual exercise. I would have thought that would be more common with a hedge fund than an investment in by an exchange. So I did some calculations myself. The volume they got in 1 year was 605 metric tons, which is better than the volume that's coming out of NCDEX, although remember that the contract is smaller. So my calculations indicate, based on a 15% cost of capital, this is a familiar calculation for you all, I assume, standard NPV calculation. Based on that, it turns out that the difference between 605 and 4,000, obviously if the cost of capital were lower, as it would be in the West, the difference wouldn't be so chronic. But given that it is about 15%, or thereabouts, roughly, If anything, this is on the slightly generous side. It's going to take them about 15 years to get their investment back. Now, if, on the other hand, you see if they started to grow that volume, then they would get the money back relatively. This is probably my most important slide, because it actually shows what life is really like in an exchange now, on the ground, when you're actually trying to make money, and you're talking about this as a commercial exercise. Now, generally, with most investment projects that I've seen of this type, if you got your money back in that sort of time frame, you'd be reasonably content. I think you ought to be reasonably content. I don't think you'd be dreadfully happy if you're waiting 15 years to get your money back. But 6 years or so is within most people's decision-making time frame, so a reasonable expectation that you would get that money back. Yes, I'm just about to finish, actually. So that's where we are commercially. But there's one last thing. They don't really care. PMEX is making money hand over fist from financial contracts. Gold, exchange rate contracts, all sorts of stuff, to the point where they're actually embarrassed by the fact that they are doing so well in financial contracts. The reason they have to launch Red Chilli, though they have done a very thorough job, and I've attempted to try to demonstrate that they have done a thorough job, and they do, all of them, care very much about making this a success, and they do want to expand their agricultural operations. They really do. But money talks. And the volume of their financial operations, you go see the PMEX website, the volume of their financial operations will continue to dwarf what they do in respect of agriculture for many, many years to come, and probably indefinitely. So, to come back to my original slide, PMEX has a strategic mission in the agricultural sector. It's why it was originally set up. It wasn't set up to speculate, for people to be able to speculate and trade off in gold and finance. It was there to help the Pakistan agricultural sector. So if it doesn't do anything to help the Pakistan agricultural sector, then there will be a certain degree of embarrassment and possibly even a certain degree of askance look in the direction of the Pakistan Mercantile Exchange. And after all, it wouldn't be the first country in that part of the world to clamp down on derivatives trading. India has done it regularly, and the Pakistanis don't want the same thing to happen to them. So there are strategic reasons for launching this contract. And that means that the conventional success criteria, which we've always looked at, 1,000 contracts a day, 10,000 contracts, whatever they happen to be, are just not terribly relevant. And maybe they weren't ever terribly relevant to most of the exchanges launching agricultural futures contracts once you broke down the distinction between a financial futures exchange and an agricultural futures exchange, which of course we did with LIFI and we did with a number of other exchanges. In the old days, when the original literature was produced, I'm sure it made good sense to think about them as standalone success criteria on their own merits. But now they are part of a strategic fig leaf, if you excuse the pun, which is necessary for these exchanges to continue to gain political support from their masters at government level. As a result, a profit itself isn't necessarily required. They're not looking at it in terms of the number of years to get the money back as being the number one consideration. They just want it to succeed if they possibly can, and therefore even relatively modest volumes would actually count this contract as a success. Anything I can do to help make that contract a success, I will do, because as I'm sure you are aware, I believe in it in its own merits. Well, thank you for listening to me. Much appreciated. Naturally enough, and I suppose if there's any questions or anything, then I'm very happy to take them.
Could they transition to more long-term contracts by just giving a rollover option on the 2-week contract?
Yeah, there's all sorts of ways they could. They haven't yet decided how they'll do that.
That would increase volume.
Yeah.
Effectively, then that would mean that you could put in place what is effectively a longer contract without having to state you've got longer contracts. You're just allowing a rollover option.
It's a good idea, and I'll suggest it to them. It might well work. There might be some issues about how it's organised and so forth, but no reason why it shouldn't work. Let's see. Yes, absolutely. It's a good suggestion.
Who owns the exchange?
They do. They're a typical self-regulating institution. The Securities and Investments Corporation of Pakistan, which was the joint sponsor of my visit there, looks down their throat all the time.
Yes, so that's what I guess
SECP.
I was really asking about the relationship with the government. So you've made a comment there, that they need to satisfy
SECP. Yeah.
This is what you're saying?
Yep.
So how does that work?
Well, SECP and the exchange pretty much see eye to eye completely. So although SECP is supposed to be the regulator, I mean, there they were in my course. So SECP, one part of the room, PMEX in the other, and you really couldn't put a piece of paper between them, which from a regulatory point of view, down the road, is a bit worrying. But on the other hand, if you're trying to make something work, like an agricultural future, I'm sure when it comes to the financial contracts, they don't just all sit in the same room together, and they're not all terribly palsy with one another. They do get regulated by SECP. But when it comes to agriculture like this, they're all on the same side, hoping that the government doesn't give them trouble generally by working together to get the agricultural futures contracts going. That's the way it seemed to me.
I was interested in to what extent is the whole process of putting this in place, does it contribute to generate economically valuable information for the profession and also for the regulator?
But
there's resistance in there.
yeah, by the professionals, do you mean the people involved in the red chili industry?
Yeah.
Yeah, well, that opens up the wider question about the extent to which transparent future prices actually affect and are useful for
not just prices,
those things.
Quantities.
Yes, well, all of it. Yeah.
Everything, all the way down to training of farmers.
Absolutely. Well, as far as the exchange is concerned, those of us who believe in the mission of an exchange like PMEX, we would be able to supply plenty of evidence that this is the case. And I can show you some of the research that indicates this, that things like quality improvements, transmission of information, that being able to get prices for months out enables decisions about planting decisions, choice of crops, risk management issues, all of these things to be done better. On the other hand, there are those, of course, in fairness, who argue that the solution lies elsewhere. The solution lies in vertical integration, for example, as you might see in the tea industry or the banana industry. And if you have that level of vertical integration, you probably don't need a derivative market like this. So there is an alternative perspective, to be fair, on all of this. And some industries perhaps are better suited. Some commodities and industries are better suited to having a grating derivative-like relationship in a market. And others are better suited to an integrated contract farming and structure. Bananas being the most obvious example that I know of, where you wouldn't really want to run it like this. But generally, if the commodity is suitable for running on this basis, then I don't think there's any doubt that it's better to have it done like this than it is to be done on a Mandi-like basis, as it has been in Pakistan for, 1,000 years or something like that, with no investment as a result, because people don't know what their numbers are and their returns are, generally. That's the best answer I can sort of give, really, I think.
So in one of the slides you mentioned that the basis rates are manageable.
Yeah.
Is that because the current time is quite short, like only 1 to 2 weeks?
No, the basis risk is manageable because grade A and grade B chilies in Dandicott are priced directly off grade A+. And the other varieties are all priced off Dandicott. So everything marches in a great big lump together. When the price shifts, everything shifts together. So you don't find the hybrid variety prices going in that direction and the Dandicott variety prices going in that direction, because that's the sort of thing, it's another sort of scandal. It's not really a scandal, but it's perceived as a scandal that can cause great problems for a derivative market. I mentioned that point about cotton. Nobody's fault, but the people trading end up being ruined both ways when it goes against them in both directions. They lose on the spot market, and then they lose on what they thought was a hedge, because they end up being knocked there as well. So it's a disaster if that happens. So it's really important and farmers might not realize that. If they don't realize the proper correlations, they could end up thinking that they were hedging themselves in the marketplace, and then discovering to their horror that they're not hedged at all. So it's useful to know that these varieties are relatively closely correlated, yes.
What's the relative importance of the
red chili to the Pakistani general agriculture?
Not huge, not huge. I mean, if you compare it, I think it's probably about 100 to 1 to wheat, something like that. This is a specialist market for sure.
So if one is successful, do you see another set of...
Yes, they do. They do. They have a list of targets, with wheat being the supreme one at the bottom, because that's what runs Pakistan. So if you, on the agricultural sector, so they have others that they want to target, and there's plenty of basis risk, which is a good basis risk, between what happens domestically in Pakistan prices and what happens with international prices. So there's opportunity, A, that you need to hedge using a local contract, but also for traders to be able to arbitrage between international prices and local prices. So that's a good basis risk. We all want that, and there's plenty of that in Pakistan due to the warehousing issues and all sorts of other things that go with them, as well as policy issues. But wheat's with the ultimate goal to get it done like this if they possibly can. And that's what the World Bank wants them to do as well.
I'm interested in the current system, the Mandy system.
Thought you might be.
It sounds like a racket.
Yeah, well, it would sound like that.
So how did that come about? You know,
Oh,
where did it come from?
Yeah, I'm no expert on where the historical origins of the system were. It's time immemorial that it's been like that farmers have brought these. And it reminds me of some of the other sub-Saharan African markets that I've looked at as well. Similar process, Kenya and things like... what was I looking at with one of the other, coffee or whatever it happens to? Similar process. Bring the stuff to market and the farmers have no idea what the price is outside an incredibly narrow geographical area whatsoever. But the brokers somehow do. And they always do know what those prices are outside, and so they arbitrage effectively. But this is a similar process to other markets that we've seen in the world, particularly SSA. It's very, very similar. But that's all I know about them. They're gatherings in that way. There are a certain number of established brokers that have been there generation after generation. Most of them, they're in that place that it's in a physical geographic location where everybody knows where it's going to be, and at certain specified times and so forth, and that's how it operates.
The trust of the growers must be important, and I guess they've been operating in that environment for a long time.
Yeah, and they don't have much choice, though. If they didn't trust them, what else could they do? It's the only place where they can sell, you know?
But now they have a choice.
Now they do.
So apparently they have managed to develop a degree of trust in this.
Well, this one's relatively easy to get trust in, because they went for a long-term trust-building operation, which we all know needs to be done. They knew their stakeholders. So they got people to go out and start talking to farmers for 2 years, 3 years before they launched. Oh, you couldn't launch a futures contract without doing that. So there was an intensive education exercise out there, talking to people, and they had this Pakistan Agricultural Coalition that they formed of local experts and brokers who were going to be willing to participate. Those who thought, well, you know, I'd rather jump on board now than get caught later. So I'll help the exchange to go and do this. And some of them out of genuine goodwill towards the creation of a market that would work. And others because they're thinking, well, I want the electronic terminal. I like the idea of being able to trade electronically. I like being able to sit in my office and do that. So there are all sorts of reasons why brokers might be sympathetic towards it as well. One major broker, though.
So I've got a tangent.
Mm-hmm.
Tell us about what Australia looks like in this world. What futures contracts do we have for agricultural products in Australia?
You know better than I do what we have here, but I think we have wheat, don't we? For sure. And others, plenty of them. Yeah, SX is very vigorous, isn't it? I've forgotten now.
It's lightly traded, though.
They always are. That's the problem. But
still
yeah.
revert back.
And there's a Western Australian wheat contract as well, with a basis risk relationship between the eastern states, with deliverable points in WA as well. I've got all that information dug back in previously, and I could dig it up now. But that's what I know exists. I know we have that. Wheat's the main one, though, isn't it? I think.
It still has a reference to the Chicago Board of Trade. You know, that's still the one that most of the merchants sort of refer to.
Yeah, I mean, I've met people in Nigeria who use the Chicago Board of Trade for contracts and are prepared to put up with the basis risk. Yeah, well, they're prepared to put up with it because they've got the liquidity. Take your pick, you know. You can get something which allegedly doesn't give you any basis risk, but if you end up with poor liquidity, then...
You can't close out your position.
That's worse.
If you need to close it out, you can't necessarily do it on the ASX.
Not necessarily. No, not in the volumes that you would want. I mean, that's the point about liquidity, isn't it? Liquidity is being able to get in and out of a marketplace using the contract the volume that you want, rather than the volume that necessarily anybody else does. So yes, we have similar markets here. They're not presented with quite the same problems, though, because we don't have the same. But what we do have here, to my surprise, having talked to Australian farmers and lectured them about this, we have the same unwillingness to get stuck in, unwillingness to manage risks. I live in the wheat belt. Now, I would expect the farmers around me to use derivative contracts to manage their risk, but I'm willing to say that I could drive all day before I could find a farmer who would actually use a derivative contract. That's the reality of it. So if we find it difficult enough to make people use derivative contracts in Australia or Hungary or Britain, which we do, how much more difficult is it, in a way, for PMEX to get farmers in Pakistan, or for that matter, sub-Saharan Africa, to go and use futures contracts? The wonder is that they succeed at all, frankly.
So what's your take on the unwillingness to take it up here?
Here? Oh, greed. Unmitigated greed. It's always a bad season. It's always going to be a good season. This is you asked my personal take. It's greed. They won't accept that there's a period over time of average direction of prices. The climate is never going to get worse. It's always going to get better next year. So when I put my crops in, what would I do? Take that price? You must be joking. I'm going to get a much better price. And then it doesn't happen. And then, well, it was a bad year. And so we start again. Same process every year. They're compulsive risk takers. And I would love to squeeze risk out of agriculture, wrench it out dry, so it becomes an efficient production process as much as possible. We can help feed people rather than getting people onto a roller coaster. That's the reason I care about all of this. Because when it goes wrong, you end up with farmer suicides, not just in India, but occasionally here too. So it's really something to try and think about. But that's my experience talking to them. That it's not that they don't understand what a futures contract is, though they haven't actually been directly approached by brokers to do this. There's also a lot of other reasons that factor about this. There's also contract farming reasons, CBH, and a number of other things that operate in this. They have alternatives, Plum Grove, and a whole lot of other things that they have as alternatives. So it's a complex position here. It's not a simple one.
I think they have regret aversion. They don't want to be
yes.
in a situation where the market price is higher than their...
That would be death, yes. But for it to be lower than their original expectations, that is life.
Yeah, that's right.
It's an extraordinary state of affairs, I must agree. They would never drive their ute uninsured. They would never not insure their buildings and their farms. They wouldn't fail to invest in the subsequent generation by investing large quantities of money, sending to expensive private schools. None of the above. But you can speculate on millions of dollars of crop on an annual basis. Remarkable. And this is something that those of us who've worked with exchanges and tried to promote exchanges over the years in organizations like UNCTAD, where we met originally, struggle with this continually. The worst place in the world to try and do this, worse than here, is South America, where the whole exercise of hedging your risk is regarded as unmasculine. And if you're involved in farming, you should be, a man and prepared to take your risks. Absolutely. And that's the sort of problem that BME has to struggle with in Brazil and similarly in Argentina. So, it's not so bad here. But absolutely. Absolutely. Oh, yes. Unless you're a speculator, in which case that's a different...
Then you're even more macho.
Well, that's right. That's right, yes. There you are. That's my pleasure. Thank you very much indeed. Thank you.